Welcome, everybody. Good afternoon. This is the first in the series of conversations we're going to have with exceptional leaders in the world of embedded finance on the African continent. My name is Adam Abate. I lead investments for Renew Capital, and I'm going to be the host of these conversations on your behalf. The purpose of the sessions is really for us to learn from the stories and experiences of the people we're lucky to speak to. And speaking of Jesse, welcome. Thank you so much for spending your time with us. For people that don't know who Jesse is, he is the CEO and co-founder of mCopa, an amazing company that we're going to hear about and hopefully hear also a lot about Jesse and his story. So before I let him tell his own story, a little bit of background on mCopa, and we're going to get into this. But mCopa is a Pan-African technology platform that to date has extended over $2.5 billion of credit to over 9 million customers across multiple countries in Africa. Jesse's been at this for many years, and he's one of the architects of embedded finance at scale in Africa, having built mCopa from a solar financing startup into one of the continent's most important alternative lending and financial infrastructure companies. So Jesse, thank you so much for spending an hour of your afternoon with us. I'm sure you're a very, very busy man, and we appreciate your time. To kick off, Jesse, maybe I'll start on a personal note. How did you arrive on the African continent? I know you've been here for many years, but could you start us off with a little bit of your personal story?
Yeah, happy to, Adam. Thanks so much for having me again. I'm Canadian. Uh, I think through the time when I was 18, never would have imagined probably even visiting Africa, never mind, spending the last 18 years of my life here. But a couple great things changed. I had a wonderful opportunity when I was an undergraduate to travel on a scholarship and ended up studying at the University of Cape Town. And through that experience, traveled into Zimbabwe and Namibia and got really interested in a lot of opportunities, I suppose, on the continent. And then after graduating most of my 20s, I worked for a large nonprofit, which was Care Canada. In fact, your colleague and our mutual friend, Lucas Robinson, and I, so Lucas now with Renew Capital, but he also worked at Care Canada back in the early 2000s. And it was at Care that I first really started to get conviction about where I thought I was actually going to spend the rest of my life, and what I wanted to work on. And I'll tell you one story that kind of puts it into perspective. In about 2005, I was in Kenya working for Care with another good friend, a guy called George Odo, from Africa Invest nowadays, so an investor. But at the time, George and I were building a project in the north of, sorry, not in the north, more in the east of Kenya in a town called Kibwezi, helping farmers access markets. And we went to meet the farmers and talk about how this was going. And what shocked me was that every farmer had a small Nokia phone in their hands, in their pockets. So they kind of kept checking them for text messages, and they knew that they were being a bit, impolite because we were supposed to be having a meeting, but they were clearly like checking a bunch of stuff on their phones. And like that isn't very special today to think about that, but it was pretty special in 2005 as a Canadian to see a bunch of farmers in Kibwezi like having cell phones in their hands. And why that was particularly surprising, Adam, was that my parents, who were in Toronto, Canada at the time, probably retiring right around that age. My mom was a teacher, my dad was an architect. They didn't have a cell phone, and these farmers did. And I was like, what's going on? How is this technology leapfrogging so quickly? And that's really part of what inspired what is mCopa today. So yeah, it was a circuitous path, I suppose, to get here. But I moved in 2010 after a bunch of work around the continent, but particularly in Kenya. I got a lucky break in 2007, and I worked on M-Pesa. I deserve zero credit for how great M-Pesa is, but I was there early and learned a lot, and started mCopa in 2010 with my then boss, who was the guy who founded M-Pesa, Nick Hughes, and the rest is sort of history.
Excellent. So as I was doing a little bit of research before this, I read your LinkedIn profile, and I read what M-Pesa does. And the first thought was, this is the most succinct but kind of rich description. And I'm going to read it because I think it's a useful example. It says, Mcopa is the world leader of affordable pay-as-you-go financial services for low-income customers. And I even messaged Lucas. I said, this is so concise. There's so much packed into there about exactly what they do. But then I spoke with your colleague Ray, and I had to throw it all out because you kind of moved on from there onto
Yeah.
something that kind of just blew my mind, and is the next iteration of what you're doing now. So maybe also just to set the context again for everybody, in your own words, what is Mcopa today, and how has what you're building changed over time?
I'm chuckling because as soon as you said you checked my LinkedIn profile, whatever was written there, I was like, oh no, I'm going to be in trouble with Ray. Um, because I bet you it's out of date. So Ray is Rayatile Tekateka. She's the director of communications for Mcopa. She might be on the call. But yeah, I was like, I don't think I've updated that for a little bit. And the new way that we express what Mcopa does is financial progress for everyday earners.
Yeah.
Financial progress is providing solutions to customers to make their lives better. And everyday earners is some very good language that we came onto quite late, let's say lately in the last 2 or 3 years, but speaks to the wide majority of adults on the continent who are unemployed but very economically active and
Mm,
earning money day to day, be that as a carpenter or a taxi driver or a farmer or a hairdresser, the backbone of the economies that we operate and live in. And we believe, and I think have found, and I'm sure everybody in the call would probably agree, financial services don't work for everyday earners. These traditional bank services don't work for everyday earners. Traditional financial services are almost intrinsically designed for the salaried employee. Everything is on a 30-day calendar, which totally makes sense for you and me and anybody in this call who gets a check on the 29th of the month to pay your rent or what have you. But if you're an everyday earner, every day is the same. There's no 30th day of the month when a big paycheck's coming through. And if you work that back out, all the financial services that banks have been ingrained and to build over centuries is really designed for 30-day earning cycles.
mm,
Everyday earners, however, are like 9 out of 10 adults on the continent. And so what are we doing to provide those financial services that work for everyday earners? The answer is very, very little. However, we as Mcopa have, at least as one company, and I'm sure there's others on this call, purposefully been focused on building solutions that work for those folks, and doing so now at scale, as you said, 9 million customers across 5 countries over 15 years. So back to our synopsis, we provide financial progress for everyday earners. And the way we do that is by starting every relationship with a customer with an asset. Um,
mm,
and many of you, I think you even referred to it already, but a lot of people will think of Mcopa as this solar company.
mm,
Um, that was kind of the case, but never the case, actually. So when we set out to build the business, we knew that we wanted to start our relationships with customers by financing some productive asset, some piece of hardware that would make their lives better, that would give them that progress. And the way we would do the financing was twofold. One, we would collect daily because they're everyday earners. So we wanted to make a proposition where you could send 10 cents or 50 cents or $1 a day for that product, and kind of lease it over time. The second thing we wanted to do was be able to use technology to shut that thing on or off based on those payments, right? So put simply, it was always believed that Mcopa would be a technology-driven asset financing platform. Okay, that's kind of the
mm,
least sexy way to say it, but that is what we do. But through that, we felt that you could build financial relationships. So the asset was the beginning of many other services that you could cross-sell, and that's also very much what we do today at massive scale of millions. So we started on solar panels and solar home systems. We were very successful in that. We sold 1 million over about a decade. We became known as Mcopa Solar, but actually we were Mcopa. It just happened to be that solar was the product. And then
right.
5 or 6 years ago, we started selling smartphones on the same basis, and that's gone really, really huge, right? That's where we're almost at 10 million smartphones as a company in a short space of time. And then last but not least, we're starting to finance electric two-wheelers, electric motorcycles, and electric three-wheelers using the same approach. So don't think of us as a hardware company. Think of us as a company that sells hardware, but with a clever embedded daily leasing program built into it. And doing that not just to sell the product, but also to build a longer term relationship with our customers over time by cross selling other financial services through the
Yeah.
device. There's
Yeah.
a lot to unpack there, so I'm happy to answer other questions, but that's the
And
simple
yeah,
and
no,
long form version of the answer.
yeah, I'm gonna stay on that for a little bit because um, innovation is different than invention. And you've put together, from what I see, components that haven't necessarily been put together, at least not successfully. Can I
Hmm.
dig in a little bit on the phone, right? You kind of
Sure.
market this as more than a phone, but I didn't know
Hmm.
this. There's an M-Copa branded phone. Can you tell us a little bit about that, the hardware, and how that fits into how you embed and deliver your financial services?
Yeah. So let me say one thing first, and then answer your question. The thing I want to say, and you know, take it for what it's worth, is, and I mean the listeners on this call, people building companies, but one bit of advice I would give everybody on this call is don't be afraid to follow the lead of what your business needs to become to serve your customers. Like the most important thing is figure out what your customers need. Once you know what that is, then the question is what parts of what they need or that proposition do I need to do? Do we need to do as a company, and where can we partner? But like just keep focused on what the customer needs. Don't let some existing business model from another part of the world tell you what good looks like, because it's not going to work here. We are operating in very different circumstances, and it's not the case that MCOPA succeeded because we saw something happening in the United States or we saw something happening in China and we just sort of copy pasted that model. Not to say that that's necessarily a bad way to start a business. So if some of you are copying a business model from elsewhere and bringing it in, that's great. But my strong advice is be ready to pivot and to iterate and to be whatever you need to be to make the best customer experience. So taking that back to what you said, like literally MCOPA today is a phone company now. We design and build and manufacture in Kenya smartphones under our own brand. That was not part of the initial vision. We wanted to be a financial partner for everyday earners and offer them a smartphone on financing with this clever on off switch. But for a variety of reasons, I frankly don't have enough time in this hour with you to tell you all the various micro reasons why we've gotten to where we've gotten to. But we have become, a hardware sort of almost design company. Um, and ultimately, the reason why we've done what we've done on the hardware and developed our own brand is one, to keep the costs as low as possible. We're dealing with customers for whom every shilling and every naira and every cedi counts. And so by designing our own products, we've been able to make them cheaper, but still really good quality. And then from what you referenced earlier, what we call the more than a phone proposition, we don't see our phones as only phones.
Mm.
We don't want the customers to see this as just a gadget. We want to show our customers that it's a gateway for financial progress. Let me give you an example of what I mean, because that's just a bunch of corporate jargon. So our phones come with embedded hospitalization coverage, that insurance. So if our customers get sick and they get in the hospital, our phones will provide them with emergency insurance. Now, that insurance is something we've partnered with a great company to deliver. We've partnered with Taraco, but we are the channel, and the actual vehicle for the delivery of this insurance is buy a phone with M-Kopa, pay regularly, and get free insurance as part of the proposition. We do that partly because we know our customers can benefit from the insurance, but we also do that because we want our customers to want to get the M-Kopa devices in order that the insurance and other services like that can come later. So it's about the proposition and the positioning. It's more of a subscription almost that comes through the phone, not just the piece of hardware itself.
Excellent. Sorry, I too am
Yeah,
based
we
in
lost
Africa.
you.
I had a brief interruption, but I'm back. I caught it though. Excellent. So hopefully, I think the audience, as I was, is struck by, the breadth and actually the subtle innovations that you're now embedding in a hardware platform, like you said, 10 million devices. That itself is a really impressive platform. So let me move on now, Jesse, to to the focus of these series of conversations, which is embedded lending, to a large extent with a focus, on providing credit. Um, you obviously you're trying to bank or provide financial services to a different segment. You made that very clear. These daily earners. You are not doing it traditionally, and you're sitting on what I guess the industry now collectively refers to as alternative data. Can you walk us through how that model works for you and why it might be a better signal than, say, like a traditional credit assessment or credit bureau?
Um, yeah, it's a very good question, although your lead is is a little bit wrong. So of the nearly 10 million customers that we have brought on board, quiz question for you, Adam. How many of
Yeah.
those customers have failed our upfront credit scoring?
Well,
Rough
now that
guess.
you've set it up like that, I would say a majority, 70%.
Well, the actual answer is zero because there is no upfront credit scoring.
Okay.
So so it's kind of hard to believe, but like let's take it from the 9 or 10 million down to just today. Like today, we will onboard about 10,000 new customers.
Yeah.
Um, we won't know this morning who those customers are going to be. We will know who they are in the course of today because we will properly KYC them, know your customers. So we will validate their ID and reference that to a database and get their phone number. So I'll know it's Adam. But that's where
Hmm.
we stop. We don't do any upfront credit appraisal of any single customer that's ever come into the mCopa platform. Never. We might, but to say we might is to assume that there is a prevailing set of information that is predictive for our customers, and we haven't found it yet. We'll always keep looking. We'd be happy to do that. But in the void of having predictive credit data that, again,
Mm.
is predictive for our use case. So can I find out that Adam is likely to pay for this phone I'm going to give you on credit, or whoever else so I'm just looking at the chat. Lubao, like Kraka, I don't know, like Lubao or Adam. To us, you're both equally eligible, and there's no
Mm.
way that we can find out up front who's good and who's bad. So we will lend to everybody as long as we know who you are through your KYC. But later, what's exciting about the way we do things is we can build a credit model based
Mm.
on how you pay for that phone or that solar system or that bike. So it's about building credit scores, not leveraging credit scores.
Mm.
That's what's been right for us. So just to clarify again to others on the call who might be building businesses in different ways, like if you can find alternative credit data that's predictive, awesome. That's
Mm.
fantastic. Um, but we've gone so far as to say there is not even alternative credit data that works. So we've built a business that doesn't need it.
That's amazing and surprising, and it's totally thrown me off my questions about data, but that's okay. So, okay, so what that implies to me is my next question would be, okay, well, how do you collect and how do you protect obviously the asset that you're deploying? But before I get there, just staying on the data question, how do you use data and what kind of data are you sitting on that, you build those profiles on? I know
Yeah.
that's not where to start, but
So yeah,
how
so
do you use
we
data?
do to build the data. I mean, mainly it's around repayments. We Some people might assume because we're selling phones, we can get all this like hidden data on people. We think that's dodgy. So there's no like scraping your SMSs and looking at your contact book and watching what you're doing on your phones. We don't do any of that. We think it's
Mhm.
dodgy. We also think it's like, if not illegal today, will be illegal tomorrow. So there's no creepy data scoping going on in mCopa. When I sell a phone to Adam, what will I know? I'll know Adam's name, his ID, his phone number. I might know a bit about where you are, not like by geolocating you all day long, but just like you bought it from this agent in this
Mm.
area. But then what I'm really going to go on is when you repay me, and all those payments, how much, how frequently, are those consistent, are those inconsistent? And all of that goes into a black box. I don't really know in the end what the machine learning model uses. Like nobody knows because you build these models in sort of black box ways. But in the end, it's the payment data that matters. Now, here's what's clever, I guess, in the end on us using payment data is the everyday element. So when we built a
Mm,
proposition for everyday earners, we said they need to be able to pay us every day, not every 30 days.
I see.
Normally, a loan is repaid in a 30-day increment. Or maybe you
Mm,
get flexible and you say, okay, pay me weekly. But let's just
mhm.
stay with monthly for a second. If I'm collecting one payment from you on the 30th of every month, after 3 months, I have three bits of data. Did you pay me on payment day
Yeah.
one, day 30, 60, 90? With M-Kopa,
Mm,
after 90 days, you already have 90 credit readings, right? And so the payment data, if made daily, is a huge amount of insight that is quite speedy and terrific. We get paid now as a business 2 million, 2.5 million times a day, or like something like 20
Okay.
times a second, right? So we have all these payments coming in. Now, the reason we can do that is M-Pesa, MTN Mobile Money, you know, other providers in different markets, but the digital element is huge. It would be impossible to imagine M-Kopa today collecting 2 million payments with banknotes and coins. That would never make it back to the bank in time. So the fact that we can collect digitally is the massive unlock. And I'm sure for many of the people on the call, you would never imagine, particularly in Kenya these days, collecting cash. I mean, that'd be crazy, right? We still collect cash in Canada and the UK. And when I leave Kenya, I put my wallet in my pocket, to go and, actually, my wallet's right here. I was in the UK last week, and like I've got British pounds right here, right in my little wallet. But like, I would never need that in most of Africa because I'm going to pay digitally. So
Yeah.
credit to the digital payment infrastructure that M-Pesa and other have built. What
Yeah.
that has allowed us to do that you couldn't imagine before is collecting 20 cents a day from 2 million people. But that is
Yeah.
possible.
I'm a details guy, so I can't get past this without asking you. Is that automated, or does somebody have to remember every day to send you something? And is that a
Unfortunately, the
conscious
latter.
design? Yeah.
No, it's not a conscious design. We would love, and I think in the future we'll be able to pull, like, do a direct debit, a daily direct debit out of a wallet. But
Mm,
say in Kenya, that is, I still think, not legally allowed. Like, you can't pull from an M-Pesa account. I think
mm,
M-Pesa can. So I think Safaricom can, but I don't think anybody else has the right to do that. Again, that might change. But no,
mm.
and what's amazing in our case is we wake up every morning and we hope that 2 million people or 2.5 million people will decide to push us a little bit of value.
Okay.
That's a very scary statement because the truth is, and I often remind our team this, like, guys, we can wake up tomorrow, and if we've delivered a poor customer service and experience, we could be out of business in like a matter of days because our customers can just stop giving us their money. The recourse we have is something, but not much. So in reverse, the beauty of that is how it makes us be very focused on making sure our customers are happy. 2.5
Yeah.
million people today will have to decide that we are worth their 60 shillings, or we are worth their, 5 South African rand, or whatever the currency is.
Okay. Great. So now let me switch to the risk, how you manage risk. Um,
Mm.
Now that you've put all these devices and assets in people's hands without knowing much about them initially, yeah, what does your risk management approach look like? How do you monitor things and keep tabs
Yeah.
on that deployed capital? Yeah.
Yeah, it's a great question. I mean, it's extensive and it's different. I think it's the two ways to quickly get into it. We are a risk company. We only make money effectively lending. Lending for the phone, lending for the health insurance, lending for lending. Every dollar we generate, or almost every dollar we generate, is risk. Therefore, we manage risk actively in many many different ways, and it's not risk that can be managed the way that traditional, at least bank risk, is managed, right? Traditional bank risk is I'm going to say, okay, Adam, I'm going to give you this loan, but you give me the deed to your house, right? Or you give me a guarantee from your employer, because if you don't pay, the employer's going to pay. Or you give me the keys to your car, or whatever. We don't have anything like that, right? And so we've had to develop our own ways to mitigate risk. The Again, there's several. We could go on for like 4 hours about all the ways that we found and the little bits that we do that I think add up. But the most important is, again, data, and uh, the fact that we're getting paid millions of times per day means that we have developed pretty incredible, again, machine learning data models that are highly accurate in their predictability going forward. So what do I
Mm.
mean practically? Today, we'll sign up 10,000 people we don't know, right? We can sell a phone to Adam, we can sell a phone to Carla, we can sell a phone to Lucas, whatever. We don't know you, but within 5 days of you guys having bought your phones, not on an individual basis necessarily, but as a cohort of 10,000 people, we're
Mhm.
going to be able to see how much money has been paid back by what's 5 days from now, Tuesday, Wednesday next
Mm.
week. And we can compare that cohort of 10,000 people after 5 days against, I don't know, thousands of cohorts that have come before. Because every day we're selling
Mhm.
10,000 phones to other people. So can you
Mm.
imagine the predictability and the accuracy of that
Yeah.
model? Because it can say literally if I was supposed to get 100 by day 5 and now I have 98, or if I'm supposed to get 100 but I got 101, like it's so smart. It can basically forecast now for us how much money is going to come in over the next 6, 12, 18 months.
Yeah.
And so we use that to then go to banks and basically borrow against the receivables that we generate. And we're very proud, to have hundreds of millions of dollars equivalent in debt from major
Yeah.
banks across the continent. Standard Bank has been our biggest partner on that for
Mm.
years. They have been great, to be honest, and took us a long time to get them over the line to sort of say, hey, we're going to do things a little bit differently here. But if you've got this much data and you can organize it this well, like this is bankable.
Yeah.
And it reminds me of a pitch meeting I had to do probably in 2010, the first year we were starting the company. I was pitching for a grant, and the
Mhm.
grant was going to be used as debt, or like it was going to be used to kind of subordinate some debt that we needed to start selling solar systems on this basis. And I was
Mhm.
asked by the panel that was considering the grant for a theory of change. I think some of you who've worked with grantors would know this is the thing. They're like, okay, so if we give you this money, we want to help you, but like, how are we going to change the world? What's your theory of change? My theory of change then, which is now I think born true, is for M-KOPA to succeed, we're going to unlock billions of dollars of capital from banks to lend
Mhm.
to everyday earners, right? Banks have a lot of
Mhm.
money in Lagos, in Kampala, in Johannesburg, in Nairobi. And then there's all these everyday earners that need money. And there doesn't seem to be a natural bridge between those two, right?
Mm.
There's no way for those banks to lend money to these people that don't have jobs and don't have credit histories. Bridging that is effectively what we've done. We've created this alternative way to bring big bank debt and put it into the pockets, literally in the form of a
Mm.
phone, of 10 million everyday earners. So that's our theory of change, and we're not done yet, but we've made a fair few strides in the last 15 years of building that theory.
Really interesting insight. I like that. Okay, let me move now to perhaps scaling across Africa. As I mentioned in the beginning, you have now expanded, and you'll forgive me if I miss any country, Kenya, Uganda, Nigeria, Ghana, and South Africa. Am I missing anybody there or any country?
Not at the
No?
moment,
Okay.
no.
Yeah.
Yeah.
So I've heard it been said, Africa, 54 countries, moving to a country is not just expansion. You may sometimes have to get entirely new product market fit, right? Like
Mm,
M-KOPA may have worked in Kenya, but it may not work in these other countries the same way, at least. How do
mm.
you decide about, what markets might be ready for you, and how do you go about, quote unquote, localizing it for that country?
Yeah. So this is such an important topic, and if I can borrow a minute, there's a couple bits of, like, again, unsolicited advice I'd love to offer to anybody in the call who's building a company. Um, Rule number one of School of Hard Knocks of building M-KOPA, I would say, is don't let your investors push you too fast to go to new markets, renew capital,
Mm.
or whoever it may be. But like, it's just so tempting, and it's always, I don't know, why, but I am sure all the entrepreneurs here will have felt a lot of pressure to go to other markets, and like, hey, it's great, should eventually, but always double and triple and quadruple think through the complexity and the challenge of going to new markets. Not necessarily for the reasons you just said, Adam, which are true, right? Like,
Mhm.
people are different in every single country, and you have to adjust your product market fit, et cetera. But just the tax and the cost of a company of going into multiple jurisdictions is like a big deal. Like the hiring,
Mm.
the labor laws, the capital, like setting up new bank accounts. Like it just quadruples your complexity by going to one other market, and then you go to another market, and again, it just gets so complex. So please, from those who have suffered the pain, expand carefully. When you do expand, not if, but when, carefully, having thought it through, I think you're absolutely right that everywhere is a little bit different. But you're also going to look for the common elements in your proposition. So back to MCOPA's MO, we want to provide financial progress for everyday earners. Okay, we're focused on everyday earners then. Question number one is, are there a lot of everyday earners in market X, right? Are there a lot of everyday market earners in Nigeria? Yes. Okay, good. That box is ticked. Second question for us, we need to collect from, in theory, millions of Nigerians on an everyday basis. How's that going to happen? Is there M-Pesa? Well, no, there isn't M-Pesa. Oh, is there something like M-Pesa? Well, actually, in Nigeria, not even really. There's no MTN mobile. Well, there is MTN mobile money, but it doesn't necessarily get used that much. So then you end up with, Paystack and other providers of digital payments that operate slightly differently, and we've had to adjust in Nigeria the way we collect to reflect the alternative digital, credit environment, but to the same
Mhm.
end, which is you want everyday earners to be able to pay you every day in real time seamlessly, right? And then,
Yeah.
you're going to go through all these different little aspects of your business model and find out if you can either do it the same way or you can do it through a slight tweak. Another
Yeah.
example from Nigeria compared to Kenya is we find that Nigerians are in a hurry to pay off loans as fast as possible. We find Kenyans, by and large, are like the reverse. They're kind of happy to take time. It's just a different cultural trait, maybe, and both are
Mm.
fine, right? But in Nigeria, it's led us to offer faster, shorter plans for repaying your
Mm.
device, and then you can get into the next products. Whereas in Kenya, people want, a longer tenor loan. So those subtleties, I mean, that's not a big deal to change on our end because you can kind of just adjust the system to set a different payment tenor.
Mhm.
But it also leads to further complexities again, which is like, oh, well, how does that change your lending relationship with the bank if you're offering 60-day loans or 365-day loans, that kind of stuff. So expand with caution, and investors always want you to go faster than I think is healthy. When you do go, be very, very conscientious in picking the right market for you at the time. And again, it might be that the market size is great. It might also be that you have an incredible person who's going to lead it for you, like a great general manager in the market, and there may be some capital available or what have you. So you got to think through everything, but think it through with a lot of care, and then know that indeed every go to market will look a little bit different than whatever it does in your home market.
Great. And we love unsolicited advice, so don't hesitate to keep it coming. On the expansion, you didn't mention regulation as a challenge. Um, have you found that to be a challenge in expanding?
Yeah, it's certainly an element. I mean, I think for us, um, or at least our core proposition of device financing and the way it's done generally isn't a super regulated thing. That's actually
Yeah.
a problem that like we would like to see more regulation.
Mm.
Um, we don't want to see customers kind of screwed over with device financing that isn't customer friendly, let's say, or like that all the T's and C's aren't clearly laid out. So there's risk in the lack of regulation, but I would say our core go-to-market proposition isn't hugely regulated. But some of the products we're getting into cross-selling anyway, like insurance, are. And
Mm.
so, yeah, absolutely, regulatory evaluations are critical. And then, I think the philosophy we have today is if, say, this other product like insurance we want to sell is a highly regulated thing, probably better to partner with somebody who knows how to deal with that. That is complexity that we'd rather not have to take on. So hence our partnership with Torako on the insurance side. Hey, they're the insurance experts. They can deal with the insurance regulation. They got a regulated insurance license. Let's do what we do well, which is sell a ton of products and cross sell services on top.
Yeah. Okay, let me continue now on a theme that you started, where you mentioned this theory of change connecting pools of finance basically to the people that need it. A lot of the people on the call with us today might also be thinking about accessing capital of some sort, debt capital largely to fund their loan books. In addition to the commercial banks, I think you have experience with development finance institutions like FinDev in Canada, where you're from, and maybe some other impact investors. In addition to just a little bit more on that experience, could you speak to, what businesses need to have in place to access some of this money? It might be in terms of data, reporting, or a track record.
Patience is probably number one. Um, I think another thing, I think we all know this, but don't, don't try to build a business, probably anywhere in the world, but especially, in Africa. Don't try to build a business that's like a 1 year, one and done, and it's off to the moon. These are decades long projects, and I really think it's important for entrepreneurs and investors to be okay. I'm going to spend the next 10 to 20 years of my life building something, and that's still like just getting it off the ground and getting it to a scale, and then it's going to go beyond that. So think in decades. That makes it a little bit easier then to think about how you raise capital from banks and DFIs and these guys who all move a bit slowly. Clearly, the first step is not to go directly to them, but to go to intermediaries like Renew, right, who are better at breaking down the kind of big chunks of money and allocating it and being a lot more nimble, than the DFIs behind them. And I think most of the development financial institutions recognize that, and therefore a lot of what they do is allocate their cash to the Renews of the world. Um, I would spend a lot of time, and you're busy building a business and you got to worry about product and your team and like engineering and all this other stuff. But it's important for either the founder, CEO, or CFO to really spend time learning about what the capital providers that they will have in the future need early. So like, hey, I want to get $100 million. I dream of getting $100 million of DFI debt in 5 years. Like, it's not too early to start to sit down with those folks and say, what's it going to take? What's the criteria? What kind of KPIs do I have to deliver? What sort of legal aspect? Like, what does this all mean? And give yourself the time to develop towards that. Right? It doesn't happen overnight. Um, and what else should I say? Um,
Was there,
just
yeah,
perseverance. Yeah,
yeah, yeah.
perseverance.
Okay. I mean, I think I remember I only started thinking in decades after I turned 40. So maybe for the
Yeah,
younger entrepreneurs out there, that might be a little bit difficult, but I think that's a really important nugget and piece of advice. So, Jesse, we
yeah.
have a few minutes before I open it up for questions. And if you don't mind, I'm going to bring it back to you a little bit as the person behind these great accomplishments. It's very easy to forget when we see a polished, finished product, how much work, how much blood, sweat, and tears went into everything. So, if you don't mind, just from on reflecting back, I'm going to ask you both for maybe a high and a low. And I'll start, let me start with a low rather than end on a low. What has been a real challenge? Thinking back on your journey, what were some of the toughest times that you can remember and, you know, what happened? Can you tell us a little bit?
Yeah, I'm glad you've asked it that way. The lowest moment in my personal journey for the last 15 years is 15 years in building Mcopa would have been, I can't tell you the day, but I'm going to guess it was around the 20th of March, 2020.
Yeah,
Okay, what was going on then? COVID. Um,
yeah.
on the personal side, it was hard because I and my family, my young family, then we flew back to Canada when the
Mm.
airports were all shutting down around the world because my dad was getting quite sick, not from COVID, but from cancer, and he subsequently passed away. But we were able to go back and get there in time to spend time with him, which was great. But I was removed from the business first of all, so I'm in Canada and it's cold and it's dark. And I remember we had a board call, and because our board calls were on like African time, it was at 4 in the morning.
Yeah.
Okay, so I'm on this board call at 4 in the morning, and the board had said, COVID's happening, world's going to hell. We want you guys to develop scenarios for what's going to happen financially to Mcopa.
Yeah.
And so we had spent a week preparing some scenarios, and they were pretty ugly. There was like what's happening normally, and then make it 10% worse, and make it 20% worse, and make it 30% worse. And even
Mhm.
that 20 or 30% worse, we were like, wow, this business is gonna it's gonna go down. Like,
Wow.
wow. It's been 10 years in the building at that point because we started around 2010, 2011. And I
Yeah.
was looking at these numbers, and that wasn't the low point. The low point was when the board said, these scenarios are not aggressive enough. 30% down should be your best case. You should be looking at 30, 50, 70% down. And
Mm.
when I say down, by the way, we meant collections. It wasn't like the whole business, but everybody assumed that our customers would pay us less quickly because COVID was going on, right? So again, we said,
Yeah.
all right, maybe it's 10% worse, 20% through 30% worse. They said, go do this again and do it 30, 50, 70% worse. And I remember looking at the board on a Zoom call, and I was like, there's no point. Like after 30, we're dead. Like we're totally, it's not even worth doing the exercise. I was so down after that call that I remember I couldn't bring myself to keep working. I was just like, it was still 4:30 or 5 in the morning. I'm like, I'm going back to
Yeah.
bed. This is brutal. So you got those mornings, right? Here's the amazing part of that story looking back. About 2 weeks later, and our credit quality had started to dip. About 2 weeks later, our credit quality stabilized and started to get better and better and better. And by like June, our credit quality in terms of customer repayments was better overall than it had been before COVID. So this was not a down 10%, down 30%, down 50. This was up 5%, up 10%, up 20%.
Wow.
Incredible that we all, I mean, maybe I didn't think, but definitely the board was like, things are going to go to hell. Everyday earners are low income people and they can't afford stuff and it's COVID, but actually they perform better, right? And
Huh.
the question is, so why?
Yeah.
And it's why because, well, these are everyday earners. They're not losing their jobs. They are still out selling tomatoes and farming the fields and like have to get stuff done to make money, like to pay for dinner tonight. And the
Yeah.
tools that we provide them, solar systems and smartphones, are part of that economic equation. If I can't use my device, I'm not going to make money. And so
Mm.
we actually saw that our customers were like the opposite of the downturn economically that everybody else saw in the world. And so in the way that is also my like proudest moment or like the highest moment is being able to prove
Yeah.
to banks and to the board and to investors that sometimes you have these total about face kind of realizations and recognize as a result that everyday earners are an incredible market to serve. They may be counter-cyclical or like oppositional to what we all expect, but isn't that brilliant as long as your business model is adapted to be different than
Yeah.
mainstream banking.
And you planned it that way from the beginning, right?
Totally. Yeah, yeah, totally. Yeah. No, I didn't go back to bed because I totally believed that it would be different. But
Yeah.
I was slowly but surely taught by our million customers at that point that I
Yeah.
did not have the right lens to think about the risk that we were going into, and in fact, the risk was more of an opportunity.
Such an amazing story. How was your next board meeting?
Boards move on, and there's other problems they want to talk about, so it was
Okay.
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 But, yeah.
Great. Amazing. That's you tell it so well and it's such an amazing both high and low. Thank you for that. Okay, I'm gonna switch gears a little and I will come back for one last question from me, but let me switch gears and take some questions from the audience if that's okay with you.
Yeah, absolutely.
Um, Great. Okay, I'm gonna read these and forgive me for reading them. Put my glasses on. So Andrew Macachia asks, who didn't believe in your dream, and how did you react to that? I assume that your model was quite hard to understand for traditional lenders.
I mean, how long do we have? Most people we've ever talked to don't believe, and even still today, even still today. I think I've learned that people get it eventually. So it's part about doggedness and about repeating and repeating and repeating. But frankly, the most important thing we can ever do is get people to come meet our customers. It's very
Yeah.
hard to pitch, and we were talking about DFIs before. Like, I could we go sit in a DFI office in London or Washington or Ottawa, and you can get some ways. to understanding. But if said individuals from FinDev or whomever can come and actually meet customers and see what we do in person, it's a totally different world. And actually, I remember when FinDev first invested, it was their trip to Kenya to meet customers who were buying solar systems at the time in rural Kenya, and the light went off. So back to like unsolicited, sort of words of advice. You're even at our scale now, you're always going to get told no more often than you get told yes. Roll with those punches, but the best way to get people over the line is to have them come and meet one of your customers, hear about the product directly, and eventually they will, they'll get it.
Great. I have another question here from Brahim, and Brahim
Yeah.
asks, he has a question about debt structuring, and he asks, did you securitize your loan book at some point?
Mm.
And if not, how did you raise debt prior to securitization with banks?
Yeah. Good question. We have not yet securitized any of the debt. I wouldn't say it's impossible in the future that we might do so, but as we've dug into it, it's a lot trickier legally and in terms of accounting than we might think. So all of the debt we've raised has ultimately been sort of leveraging our balance sheet, and we carry, the company ultimately is carrying the credit risk.
Great. I have a question from Alex Rugema. His question about is about the transaction fees that he uses the word payment gateways, but I assume in this case that would include M-Pesa and similar systems across other countries. The question is they often charge high percentages for transaction fees, which can kill
Sure.
your margins.
Mm.
How do you deal with that? Do you use third parties? Are you planning to develop your own solution for collecting payments?
Yeah. Just before I answer that, I'm watching the chat and I want to thank Renish Adhiambo, who sounds like a customer as well as one of your caller or viewers today. He's talking about his M-Couple phone. So thank you, Renish. That's very nice to hear. Speaking of Renish, assuming he's in Kenya, we don't pay much to use M-Pesa. That's brilliant. M-Pesa is free under 100 shillings, and almost all of our products are priced at less than that per day. So thanks to M-Pesa, a lot of those payments are cost less. However, transactions over 100 usually cost about 1%. And in many of our markets, we see 1 to 2%, maybe 2.5%. I think all that's manageable. It's kind of worth it for the simplicity and the speed that it brings. But in other markets, particularly in South Africa right now, it's really hard to move money for less than 4 or 5%. And that
Mm.
is a challenge to our business and the affordability there. And it's our smallest market, and that's one of the driving reasons. So I'm a big believer that over time these things will get cheaper as more companies innovate and release digital payment solutions. There's only one way to go on pricing, and that's down. But I would encourage everybody to build, digital payment-based businesses where digital payments are as cheap as possible, if not free.
Yeah. And again, it's just one of these pieces that seems to fit perfectly, whether it was designed that way to begin with or not, but it does. The fact that under 100 is free and you're doing these daily small ones, so it all works really well. Interesting. Okay. I have a question from Christiane Oiba. The question is, if you were raising capital for M-Kopa today from scratch, what might you do differently?
Well, yeah, what would I do differently? I It took a long time to articulate the everyday earner, to be honest, and that's been very powerful for us as a company to focus on who we want to serve and also help our investors understand, the market and the way we design our products and our repayment proposition. So, um, I guess what I'm saying is I would spend a lot of time being very, very explicit about the customer I'm trying to solve a problem for and how I'm solving
Mhm.
that problem. And I wouldn't sometimes I meet investors who be like, you shouldn't sell to that customer, sell to this customer. And I would just be like, thank you, that's been a good meeting, but no, I'm gonna solve this problem for this customer, and I know what I want to do, and I'm not going to take too much let that get off course. I said it before, but this isn't from scratch, but very early it was like, oh, and we're going to do this in Kenya, and then we're going to go to the world. Like as soon as we can, we're going to be in market number two. Big mistake, big mistake. We burned a lot of money and a lot of calories, and almost didn't make it as a business, effectively because we spread ourselves too thin, too far. and actually
Mm.
bringing it to digital payments, as you said a minute ago, Adam. So, sorry, let me say this more concretely. We started the business in 2010. By 2013, we were, maybe in 2012, we were in Uganda. The next year, we were in Tanzania. The next year, we were in Ghana. And then we had to retreat and we closed what we were doing in Ghana and what we were doing in Tanzania in order to save the business, stayed in
Mm.
Uganda. And then we've since re-expanded, right? The thing that we didn't have in those markets then was low cost and widely available mobile money. So
Mm.
customers couldn't pay very easily. And we kind of got enticed on the idea that we would help create a use case for those payments. But like, God, that really wasn't our problem. We should have stayed much
Mm.
more focused where we were. And so back to like, if I started again, I would tell investors that whilst we have appetite to scale this business and the potential to scale this business in time, I wouldn't take the bait on doing that too quickly.
Mm.
And then the other thing I would do differently is never compromise on culture of our team.
Mm.
And I'll be honest, I did. I made some bad hiring decisions. People who had pretty great skills and particularly awesome CVs, but folks who, in my gut, I didn't believe were right. And sometimes I
Mm.
couldn't even say it out loud. It just didn't give me a great feeling. And I sometimes listened too much to what investors thought
Mm.
I should do in terms of hiring. And every time, and still, like I've done this recently as well, and I'm like, gosh, why do I have this bad habit? But it's so important as a founder to really hire with your gut. And if you stray from that, it'll cost you. It just leads to such a anyway cost to your company. So
Yeah.
those are my quick thoughts is be very explicit about the customer you're trying to serve and the problem you want to solve. I wouldn't
Yeah.
be all about expansion too early, and I'd be very careful about who you hire.
Yeah. I'm struck, Jesse, how you brought your customer into fundraising and investor discussions. I think it just goes to show how central it is to everything. I wouldn't have thought that, but another really interesting insight. Okay, I think we have time for maybe one or two more questions. I have one from Hamid. He says, how challenging is it to raise debt at the local level with local currency instruments? And how has that evolved over time?
Hmm. We're yeah, it's just really challenging. I think maybe we made it more challenging sometimes for ourselves than we needed to. A lot can be said if you can develop a good relationship with a senior person at a bank that believes in you or believes in your market. And so, like, yeah, let me put it this way: if you can get the local bank CEO, then maybe it's even a smaller bank, right? Uh, Whatever the ticket size, you think you want 10 million of debt, US equivalent, and you can get two. But if you can get that CEO or maybe that chief credit officer to come and meet your customers and see your team and stuff, you probably got something on the hook that you could continue to work. Um, so I think in the end, it's a lot about convincing people individually and then having them go back into their banks and like fighting to get something that's a bit unorthodox done. It's happening more and more. You know, banks are on the continent becoming more agile and more open. And as you have fintech companies that are succeeding, um, there's more to do. You know, there's more appetite. So be dogged on that, but don't necessarily. Yeah, go with the people who seem to be keen.
Yeah, great. Okay, I have two more questions because one great one came in, and I was reminded that maybe I didn't push you hard enough on this particular question, which we got from a number of people. It's going back to defaults and collections. How do you handle defaults, and what collection and recovery mechanisms have you put in place?
Mhm. Yeah, so look, our main collection mechanism is that the phone or the solar system or the electric vehicle shut on or off based on payments, right? So that's how it happens. So if I pay for 50 shillings for my phone to work tomorrow, it'll work for 24 hours, and then I have to pay again, and it's locked. In the meantime, um, we also, interestingly, you know, if I paid for my own Copa phone today and I can't afford to pay for it tomorrow, and I want to pay for it again on Sunday, I don't have to pay arrears. I don't have to pay for what I missed, which is super unusual, but designed for the needs of the everyday earner. and that has led to a lot of customer loyalty. I think the last thing that we're very proud of is we have a customer protection policy that says if at any point our customers want to return their devices to us, they can do so, get their deposit back that they paid up front, and actually have no further obligations from us, which is a great offboarding mechanism, but it also allows us to take those phones, refurbish them, and sell them again. And so I guess what I'm trying to say is be creative again in your collections policies. Don't follow what banks would normally do necessarily, unless that's right for you, and be willing to think a little bit different about what collections mechanisms work for your product and your customers.
Okay. We have 2 minutes left, Jesse, and I have two questions. So feel free to be brief on this first one. What's the long-term vision for M-Kopa and what's next? That's one. And then I have one more for you.
What's next? We are very keen, excited to be on a path to 10 million active customers. It was said earlier, we've got over 9 million customers cumulatively, but about half of those are active today. And we want to make sure we do a better job of not only selling our customers a device that's making progress for their lives like a phone, but we're offering them the insurance and the credit and the savings and the other things that they want through that device. So active customers, we think will be at 10 million soon enough, probably around 2030.
Yeah.
And that's really the North Star. I think we can get there in the markets we operate in today and doing more or less what we do today. So
Yeah.
that's the sort of near-term vision.
Excellent. And my final question before I thank you very much for your time is if you could leave the founders on this call with us with a parting gift, whatever that might be, it might be a system, a tool, a nugget of advice. What would it be?
Just keep walking. Just keep walking. Um, and you don't have to have the answers. Like I don't have all the answers for MCOP has been somewhat successful, but like I don't know. There's a lot to be said for your commitment to your customers and your mission, your team, and the fact that you're just willing to keep going. If you shut down in a big rainstorm, I mean, you're just going to washed away. But if you just keep plodding through those dark hours, uh, you know, sunshine comes back out, and you got to be able to switch your path and pivot. I think that's another main thing. Don't be afraid to pivot when you need to.
Yeah.
Um, in the long term, things will work out.
Excellent. Jesse, thank you so much. It's been a real pleasure. Um, Lots of interesting insights. We all know a lot more about how M-Kopa works, and we got to spend time with you, which has been amazing. So thank you very much for your time and all the insights that you shared with us today.
My pleasure, Adam. Thank you so much. Thanks, everybody. Have a great weekend.
Cool. Bye.
Bye.